Good afternoon. On behalf of CBRE Hubbell Commercial, welcome to the 2021 Commercial Market Survey Reception. We very much appreciate your attendance here today. We hope you find the program informative. This year's event will look a little different than years previous. I know our team looks forward to a 2022 market survey reception when we return to our traditional March timing and also the socializing in person afterwards. The past 14 months in the commercial real estate market is best characterized as ever shifting and at times has felt very erratic. From March to June in 2020, our team was focused on negotiating rent deferments, rent abatements, and extending closing dates. Force majeure and pandemic clauses became major negotiating points in commercial leases. Terms like essential retail, omni-channel delivery, work from home, and hybrid work strategies became part of our everyday vernacular. None of us knew what the remainder of 2020 or what the beginning of 2021 would bring to the commercial real estate market. What did occur is an incredible amount of pent-up demand and appetite for segments of the marketplace. Low interest rates and massive amounts of capital available generated record-setting levels of commercial investment activity in Central Iowa. The strength in Central Iowa's demographics and our consistent economic growth have increased developer demand for land opportunities across the metro. The industrial market has become stronger and stronger, as evidenced by the unprecedented amount of new construction and companies requiring warehouse for e-commerce needs. Even the retail market persisted as the second-generation restaurant opportunities that had become vacant early in the pandemic were quickly backfilled by stronger operators. We are enjoying our 24th year of affiliation with CBRE. The CBRE network affords us unrivaled resources and connections to markets throughout the United States and the world. One notion that was reinforced even during the pandemic was how fortunate we were to work and live in the Des Moines MSA. The level of private-public partnership, corporate sponsorship, and commitment to bettering the quality of life for our area's residents was admired and is admired by peer cities of all sizes. All this has added to very positive results in the commercial real estate industry, and specifically at CBRE Hubbell Commercial. We thank you, our clients and partners. We recognize that our team's performance depends on the relationships and the trust that we have built with each one of you. Thank you for that opportunity. Additionally, our successes would not be possible without the dedication of our team members. If I could use one word to describe our team's performance since March 2020, it would be perseverance. The team has remained committed to achieving the best possible outcomes for our clients and pivoted when required to react to these ever-shifting market conditions. I am blessed to work with a very high-performing team and would like to take this opportunity to introduce each one of them to you now. Rick Tolleson, President and Chief Executive Officer. Kyle Gamble, Executive Vice President and Managing Director here at CBRE Hubbell Commercial. Dakota Albrecht. Corey Birkenholtz. Blake Bogenreef. Max Colby. Tom DeWay. Tyler Dingle. Michelle Drummer. David Eckley. Katie Essing. Di Fox. Linda Gibbs. Ray Hamilton. Marty Herman. Riley Hogan. TJ Jacobs. Ryan Jensen. Colleen Johnson. Craig King. Maury Knutson. Rick Krause. Harrison Cruzy. John Ladinsky. Mike McCree. Kermit Marsh. Josh Masters. Todd Malang. Aiden Nadarvich. Shayna Patrick. Chris Pendroy. Dick Powell. Tim Sharp. Mike Smith. Jeff Spence. Ned Turner. And Naja Worth. Grant Wright. We are blessed here at CBRE Hubbell Commercial with a tremendous marketing team, Lauren Miller-Brown and Suzanne Muntz, who are instrumental in the planning for this program today. They lead our marketing team and are responsible for all the marketing materials that our firm is able to produce. do a terrific job for us. Finally, I'd like to introduce Zach Shekel, our Property Research Director here at CBRE Hubbell Commercial. We believe that quality research is a core component to how our team is able to provide the highest level of commercial real estate consulting. I hope you have enjoyed the quarterly market updates that we distribute on the industrial, retail, office, and multifamily markets. Zach leads that charge and will kick us off with a macro view of the markets.
Thank you, Bill, and thank you everyone for tuning in this afternoon. I wanted to start things off by giving you guys a 30,000-foot view of what we've been seeing in the market over the last 15 months or so. I'll then turn it over to the guys in the trenches, our panelists. We'll do a deep dive in their respective markets, and will give us insight on where they see things heading for the balance of the year. Let's begin with multifamily and industrial, two markets that weathered the storm fairly well, respectively speaking. Multifamily did face its challenges, though, with the 2020 spring leasing season matching up at the height of the pandemic. Absorption gains were tough as a result, keeping vacancy around 7% for the remainder of the year. However, investor appetite remains intense for multifamily assets as sales volume increased 20% from record levels in 2019. Industrial. It's no secret industrial is the darling asset class of 2020. The rapid adoption of e-commerce fueled strong user demand and market growth. The market added 1.2 million square feet of speculative space in 2020, over half of which was absorbed before year end. However, industrial strong performance came at the expense of retail, as 30% decline in new leasing resulted in upward pressure of vacancy levels across all property types for the entirety of 2020. And finally, office, the property type that perhaps faced the strongest headwinds in 2020. The office market recorded 400,000 square feet of negative net absorption on the year as new leasing fell almost 40%. This increased overall vacancy by 2.5% to a metro-wide vacancy of almost 15%. And on that note, I'm going to turn things over to TJ, who will elaborate further on the temperature of the office market.
Thank you, Zach. Thank you for the opportunity to share some of my thoughts on the office market. In a very hot investment real estate market with sales pushing record highs and asset classes like multifamily and industrial, it's nice to know occupiers and investors can find genuine value opportunities in the office sector. That's my one positive comment on the office market. As in previous downturns in 2000, 2001, as well as in 2009, the Midwest and Central Iowa will continue to remain insulated from severe drops in office space demand. Specifically for Des Moines, we remain a very corporate-oriented office market, with large portion of the office space controlled by owner-occupied buildings for insurance and financial service companies. Rental rate growth is not anticipated over the next 24 months. Vacancy rates will continue to rise in both downtown and suburban markets. In general, rental rates will hold steady in the suburban market, while we anticipate rental rates will drop in downtown. Based on my own tenant representation and landlord work, we're seeing exactly that. The Class A suburban office market continues to hold while downtown is becoming more competitive as the landlords fight for tenants. Take you through some graphs. This first graph, hitting on office occupancy during the pandemic, is pretty telling for what happened to the office market in general. This is across the country, but also indicative of what we saw here locally. In between basically end of February and March to April of 2020, we saw a drop of what was occupancy in lease space in that 96% range of lease space down to below 20%. Again, that's very telling of what the impact COVID had on the office market. As far as other indicators here nationally, vacancy rate has increased to 16%. Gross asking rents have dropped at $34. That's a national average. Net absorption dropping as well to nearly 35 million square feet. A couple of points though, certainly for downtowns across the country, COVID hit the downtown office market harder than suburban. And that's certainly different than what past downturns have seen. One other component that we're seeing nationally that we haven't quite seen here locally is in the gateway markets, markets like San Francisco and Los Angeles, Chicago, and New York. They are seeing strong office I guess, activity and longer-term leases being signed, something that we really haven't seen here locally. Another mark, just something to point out in the orange, that the vacancy rate, basically from the first quarter of 2020 to the first quarter of 2021, see a dramatic 4% increase there. Again, a very dramatic change in terms of occupancy. We saw a very nice trend line over the last 10 years, and it's something that certainly changed overnight with COVID. Again, as we look at vacancy rates, this is very telling of the impact for downtown versus suburban. Obviously, all of office space has been impacted, but significantly more in downtowns. The other component over the next couple of years that we'll be seeing an uptick of is sublease space. As occupiers make more decisions in terms of how much space they do need, we're going to continue to see more space on the market. Looking here locally in Des Moines, as Zach mentioned, just the negative absorption that occurred in this past quarter, nearly 273,000. I think Zach had mentioned over 400,000 over this past year. It's a trend that we don't like to see here. Some of that is a component of new construction hitting the market, but a good portion of it is actual corporate users and folks reducing and vacating the market. In terms of another trend line, the vacancy rate, we're actually trending very close to what the national average is at 16.2%. Downtown at 17.4 is something significantly higher than what we've seen in previous years, and the suburban market being at 14.5% here locally. Certainly higher, but as we've seen in previous downturns, I think it's within reason of both in the 2001 as well as in the 2009 downturn. Asking rents, this is something that we see over the next couple of years that certainly will be holding steady. As we look at rents, there's certainly components of tenant improvements and other factors, but we do see rents either holding steady in the suburban market or like in downtown, we do see that dropping. Provide some near-term outlook. Today's market is an office tenant's dream. Unfortunately, uncertainty in their own business and headcount needs based on hybrid and work from home scheduling is keeping occupiers from taking full advantage. Short-term renewals, as is short-term new leases or leases with built-in early termination options are the norm. A 5-year lease is considered a long-term commitment by many occupiers, both locally and nationally. I had a chance to pull studies by CBRE, also consult with a large number of asset management groups, as well as a large national occupier. Each source provided very similar comments. If corporate office space was going away based on technology and the ease of remote work, it would have gone away well before the pandemic hit. Employee onboarding, employee growth, company culture, as well as productivity for many knowledge workers suggest that work from home will not work for the majority of office occupiers. What will be changing in corporate office space is increased use of social hubs, training and collaboration space with work cafes and on-site perks. The hybrid work model will likely continue giving more employees flexibility on their work-life balance and will be factoring in on seat counts of occupiers. Landlords facing renewal exposure or existing vacancies will need to be thinking of ways to best position their properties. If the properties are aged, they may want to upgrade systems as well as amenities to stay relevant. Clean and updated office environments will be sought after and will include touchless features such as doors, elevators, sinks in bathrooms, clean air HVAC improvements such as ultraviolet light systems, clean purified water stations, strong janitorial service partnerships. Many tenants are going to be asking questions, not about how many days a week that you're receiving janitorial, but specifically what kind of cleaning products are being used and what services are actually getting cleaned. Outdoor amenity spaces will also be a must. Newly constructed or properties under construction are certainly incorporating these measures. Sherman Associates project south of Martin Luther King Drive at Gray's Landing in downtown Des Moines, and the Oaks on Grand in West Des Moines by Galloway Holdings are 2 new projects that are able to offer a good number of these measures. Larger existing projects such as 1200 Locust, owned by Nationwide, originally built with LEED standards, also offer these measures. Even boutique projects like 130 East 3rd achieved LEED Platinum and boast these clean office environment measures. Moving forward, these features will help the lease-up and renewal efforts of these projects. In closing, the office market will continue to be challenging for landlords in the next 12 to 24 months. Tenants have the upper hand in negotiations. However, the net savings in rental rate or free rent will partially be muted by the cost of tenant improvements on construction as well as material pricing. The days of $5 per square foot new carpet and paint on a renewal is well in our rearview mirror, as those costs are closer to $15 per square foot today. As we work through the next year, we can all look at small anecdotal evidence of the office market recovery. Confirmed back-to-work schedules from all major employers will be the first major step forward, currently planned between July and September of this year. Longer commute times to downtown, surface parking lots and parking ramps being filled with cars will also be signs of office recovery here locally. Eventually, that will translate into longer commitments of space by tenants, which will be a welcome change for landlords. Thank you, and please feel free to contact me offline with any questions or comments. Next up is Mike McCree, handling the industrial market.
Good afternoon, everyone viewing and listening online. If any of you are watching this and have the desire to discuss my comments in greater detail, I'd gladly like to set up a meeting with you or a call to discuss the market conditions at a later date. I'm going to be going over current and projected market conditions, not only locally, but nationally, that have caused and affected the current boom in the industrial property demand. Rather than focusing on specific sales and leases within the Des Moines marketplace, I'm going to be discussing economic conditions from a historic, current, and projected perspective into the near future. These conditions have created and will continue to create the tremendous growth in all aspects of the industrial market. First, we should reflect on changes in the product type in the metro over the last 20 years. From 2020 to 2010, the average industrial building constructed, owner-occupied or for lease, was just over 39,000 square feet in size and had a 19-foot clear height. By 2010 through 2015, the average size rates had increased to 83,700 square feet with a 23-foot clear height. From 2015 to 2020, the average size had ballooned to 104,200 square feet and 25-foot clear. This increase in project size is a nationwide trend. Nationally, the average building age for buildings over 300,000 square feet in size is 8 years old. The average age for buildings over 100,000 square feet is 17 years old. And the average construction date was 2004. However, the average age of projects under 100,000 square feet is nearly 30 years old, with the average construction date of 1990. This is driven by several factors, primarily large amounts of investment capital being invested in industrial development. Locally, the demand for larger building sizes has prevailed, has been prevalent since the early 2000s in the Des Moines metro. But the development market was driven by smaller, less capitalized investors and developers building the same products in repetition. Fast forward 20 years, and the metro has become a more desirable place for larger developers such as Ryan Companies, Turner, Ovis, and Van Trust, but also large investment funds and large capital investment entities. The increase in outside investment to the market has permitted the construction of increasingly larger products to the market, and the market has desired these for decades. Secondly, population growth. Over the last 20 years, the Des Moines MSA has increased in population steadily by an average of 2% annually. This steady methodical growth has created a dramatic increase in population rate compared to the Midwest markets. Over the last 5 years, the Des Moines MSA has increased in population by over 56,000 residents. That's nearly equivalent to the entire population of West Des Moines, and greater than the entire populations of Ankeny and Waukee combined in just 5 years. This population increase is a key driver in the construction and contractor and services industries. Over the same time frame, the size of buildings has increased, effectively decreasing the availability of smaller products as new supply has not added to the market as steadily. As demand has increased and zoning code regulations have become more restrictive, smaller industrial spaces have become more and more difficult to find. The rise of e-commerce and the converse relation to the retail demand and retail demand for traditional venues like malls and shopping centers to online services has created a huge demand for bulk warehouse and distribution space from online and omni-channel retailers servicing the United States. In 2000, e-commerce uses accounted for 20% of all industrial leases nationally. While we typically think of major online U.S. business companies like Amazon, online retailers originating from other countries, such as mainland China, have begun opening new distribution centers in the U.S. Locally, we have not experienced this trend of foreign retail investment to date, but we have certainly benefited from the investment made by domestic e-commerce users such as Amazon. When discussing large e-commerce effects on the industrial market, you cannot overstate the effect Amazon has had on the sector. In 2020, Amazon leased or constructed 77 million square feet nationally. That's more than the other top 20 users in the U.S. combined. In 2021, Amazon has leased just over 20 million square feet by the end of Q1 2021. They're on a slower pace than 2020, but are still expected to lease or purchase close to the 2020 record number of square feet. In Central Iowa alone, Amazon has occupied large-scale facilities in Grimes, Ankeny, and Bondurant. From a national perspective, CBRE predicts 330 million square feet of new industrial space will be needed in the next 5 years simply to meet the demand of the e-commerce sector alone. 3POs, or third-party operators, continue to be one of the largest contributors to warehouse and distribution activities in the U.S. 3POs control over 29% of the total market nationally, followed by manufacturing and e-commerce. Locally, we've experienced the boom of 3PO growth above any other single user or sector. In short, demand for industrial space of all sizes sees no sign of decreasing in the foreseeable future. CBRE's National Research Department is projecting industrial growth nationally for at least the next decade. The trend of onshoring or relocating products from overseas to the U.S. is real, but not as may be expected. Large manufacturers and wholesalers continue to move more product to the continental U.S. For distribution facilities to mitigate the effects of supply chain and global logistics slowdowns and delays. Ford is a great example of this. In 2020, Ford added 20 million square feet of warehouse and distribution space to better control supply chains for their plants. However, nearshoring or locating in North America versus continental U.S. is more prevalent. In the last 12 months, more companies have moved production from China to Mexico than overseas to the U.S. Continued border closures, tariffs, and international logistics issues will be ongoing points of observation as this strategy is still being evaluated. From a local perspective, we have several factors affecting rental rates and growth rates in the Des Moines Metro. For example, we should look back to 2000. In 2000, new construction industrial projects under 50,000 square feet were leasing for $350 a foot triple net. Larger high-cube projects were leasing for sub $3 a foot ranges. In 2015, the same projects were still leasing $3.50 a foot, and high-cube space was still sub $3. Effectively, valuations were driven by cap rate compression and reduced leasing costs. In 2021, these same projects are now leasing for $8 a foot triple net, and high-cube industrial space is very close to the $5 triple net mark. Parenthetically, while we have yet to see high-cube projects marketed at a $5 a foot triple net range in the market, in the metro, we have effective lease rates that are in place that when stripping out free rent, TI concessions, tenant improvements, and incorporating CPI increases, the rental rates are in fact above $5 a foot. In short, industrial rental rates in Iowa, and specifically Des Moines MSA, were flat for nearly 15 years before we started to see increases in these rates. These increases in rates have been primarily driven due to the lack of supply and increasing construction costs. This has led to a steep increase in net rental rates over the last 5 years. While this increase has been a source of contention between landlords and tenants, the fact of the matter is the current rental rates are below the simple rate of CPI or inflation increases over the same period, and still below the national average rental rates, which are above $8 a foot. In other words, industrial rates are still below the historically adjusted level that they should be. Rental rates have approximately 40 cents to 50 cents per square foot to increase before reaching equilibrium with the historic inflationary levels. Secondly, the same inflationary factors that have increased rental rates have increased the material costs even faster. CPI increased in May by an average of 5%, the largest increase in recent history. Commodities prices have reached record levels for products such as steel, aluminum, lumber, and glass. and other materials in the construction trades. This is not news to anyone that follows the media outlets that have been discussing this for months. What we need to consider is the effect of the rate of increase in costs versus the cost of interest rate increases over time. For example, a 200 basis point increase in interest rates has less of an effect on finished product than the development than the current price spikes in material costs for construction. Since December 2020, construction costs on average have increased 25%. For a $5 million project, this equates to $1.25 million of additional costs. The interest effect of a 200 basis point increase over a 10-year life of a loan for a similar project would only increase the cost by half that amount. In short, inflationary effects on material costs are having a greater effect on new construction than even the worst case scenario interest rate increases projected for the next 12 to 24 months. Luckily, commodity prices and futures are beginning to decline and from the higher levels earlier this spring. Commodity fluctuations, delays, and supply issues based on natural disasters and weather events like the freeze this spring in Texas will be a part of the industrial market and construction in general for perpetuity. We can address these issues and account for them effectively to mitigate the effects. Furthermore, the unstoppable demand nationally for industrial products has partially caused and will continue to push through the supply chain issues. The pandemic was predicted to slow growth in demand. It has had the opposite effect. Demand for industrial space for tenants is up and not waning. Demand for industrial products as an investment class has grown and continued to increase locally and nationally with little signs of slowing down. Investors struggle to find replacement 1031 products as REITs and insurance companies look for inflationary hedges on investments. In summation, locally, the industrial sector is extremely well positioned for continued and future success. The Greater Des Moines MSA will continue development and expansion within the sector. We can expect rental rate growth to continue above the average rate of inflation for the foreseeable future. Additionally, building sizes for new construction will decrease in some projects as owner-occupied options become more appealing to renting as rents continue to climb. Expect to see 150,000 square foot to 300,000 square feet and 20,000 to 40,000 square foot buildings as the norm, not the exception. Nationally, Amazon and other large occupants will continue to make headlines and drive the market. Amazon is expected to build or lease roughly the same amount of space as in 2020, 77 million square feet. Additionally, the desire for supply chain control by large manufacturers, distributors, and warehouses will continue to spur national demand for high-cube space for the foreseeable future, as the events of the last 15 months have exposed a weakness in the just-in-time manufacturing mythology. There are 5 key factors that we're watching to continue to gauge the market. Number 1 is population growth. So long as Des Moines continues to grow at a 2% average annually, demand for 3POs, e-commerce, and local service contractors and spaces of similar use will drive the growth. Number 2 is use needs. During the beginning of the pandemic, I realized the key sectors that will continue needing physical space include HIPAA-regulated industries, governmentally licensed businesses and industries, and businesses needing to protect people, product, and information. Any of these uses require a physical address outside the home. Users within these 5 categories will continue to drive and need space. Warehousing, manufacturing, distribution are within these categories. If you're a landlord, our industrial team members here at CBRE Hubbell can help you fill your vacancies and prepare for re-tenanting, targeting these key demographics. Number 3, architects are reporting slower billable hours in the start of Q2 2021. This will be short-lived as commodity prices come down from the historical highs. In general, demand for new space will outweigh the cost increases and continue to drive the market for the next 18 to 24 months. Future increases in interest rates have less effect on total cost than cost of construction material increases. Additionally, don't fear impending inflation. As a property owner, rental rate inflation will continue to drive your rent higher. The increase in rental rates will be the methodology to increase valuation once interest rates begin to tick higher. As we shift from a cap rate compression to a cap rate expansionary environment, valuation will be increased by increases in income vis-a-vis decreases in cap rate. Parenthetically, make sure to include cap rate increases in your leases and assumable financing terms to permit valuation capture by assigning low-cost debt during the possible sale. And then finally, number 5, while building ever larger buildings is the current market trend. Don't overlook the small users. 20 to 40,000 square foot owner occupants have been overlooked segment in this market for nearly a decade. Space demands and sheer number of users necessitate more buildings of this size for the foreseeable future. Overall, locally, regionally, and nationally, the industrial sector is growing and prospering at all levels. With unprecedented demand, we will have supply and logistics issues, i.e. commodity effects, but the current net rental rate is still below the historically adjusted rate based on inflation. All factors collectively point to further increases in demand, rental rates growth, and growth within the sector for the near and long-term future. I'm now going to turn it over to Grant Wright, who's going to discuss the retail sector.
Thank you, Mike, for that very detailed update on the industrial market. I'm going to talk a bit about the retail sector today. It's not quite as active and hot as the industrial market, but we'll still get into it. Some topics I'm going to cover: COVID-19, how that impacted retailers last year and how they're still feeling those effects today. I'll talk a bit about big box retail, and then we'll end with a bit of future outlook, some active corridors where we're seeing future development and what that's going to look like. First graph that I wanted to bring to everyone's attention. This is from National CBRE, and it is March retail sales impacted by COVID-19 from 2020. As you guys can see, grocery stores were up 26.9%. Few other things were up, and then pretty much everything else across retail was down, with the worst being clothing and clothing accessory stores down 50.5%. So retail definitely took a hit from the pandemic with all the store closures and limited capacity. How that affected our Des Moines market, we look at where we were at Q1 2020. This is vacancy across Des Moines. Neighborhood and community center, we were at 9.6%. Today we're sitting at around 12.5%, around 300 basis point increase. You look at big box, we were at 4.4%. Today we're at 5.9%, 150 basis points. So vacancy did go up during the COVID or from the pandemic. I will say it is important to know, if you look at Q2 2019, retail did have its challenges before the pandemic. Vacancy was already on the rise, so we can't just say that everything was from COVID, but it definitely accelerated those challenges. On the flip side, surprisingly enough, this is a graph of retail investment sales volume in the Des Moines area, and 2020 was a record year for the Des Moines market. We had over $100 million in volume of investment retail properties. Most of that, as you can see, that blue bar was single tenant net lease properties. We keep hearing about essential retailers, classify those as grocery stores, gas stations, dollar stores, and quick serve restaurants. We found that from COVID, there was a real high demand in those, and with the low interest rate environment, people were buying those things up. So it was a really good year in terms of from an investment standpoint, and that trend has continued into 2021. We look at the first quarter of 2021, and we're already above $60 million in investment volume. Most of that's from the Fleet Farm in Waukee, selling for over $38 million, but nonetheless, we're predicting another record year this year. Going into some other things that COVID impacted, e-commerce, Q1 2020, nationally, 8.3% of total sales. This is all retail sales were done online. Fast forward a year, and that was up to 13.6%, a 39% increase. So substantial increase. That number was already increasing over the years, but again, COVID accelerated it. We go to restaurants, and it had a pretty negative impact on restaurants. We had some pandemic-related closures. Iowa Restaurant Association estimated a $1.45 billion hit to Iowa's hospitality industry in 2020. They estimated that around 12% of restaurants in Iowa permanently closed. I will say that that's better than some initial reports that came out around 20 to 30%, or estimates, I should say. And one positive that we've seen in our market over the last year is that of those 700 restaurants that closed, a lot of them have gotten backfilled pretty quickly with experienced operators that were ready to take advantage of those second generation spaces. We saw an increase in takeout and drive-through usage. A lot of our clients that had drive-throughs reported higher sales in 2020 than 2019, even though, coming into the store was closed for a lot of it. And then one surprising thing about restaurants that people might not have predicted in the beginning was the labor supply. Right now, we estimate that staffing is down about 25,000 employees across the industry. People who are going out to eat right now this would not surprise them. And, ultimately it could result in higher prices being paid by us customers if restaurateurs have to keep paying their employees more to keep them. There's just not as large of an employee pool as there was before COVID. Last thing about COVID I want to touch on is just some government assistance. PPP loans, a lot of 2020 we spent helping out our tenants, and we had some proactive landlords help tenants with PPP money. That was likely because they needed them to get that money so they could get paid some rent. But we also have further assistance coming into this year, the restaurant and bar relief. That's from the Iowa Economic Development Authority, $40 million program to help out solely Iowa restaurants. The American Rescue Plan Act, that was a $28.6 billion restaurant revitalization fund. That's national, but definitely helping out tenants in Iowa as well. And also some lifted restrictions. Iowa lifted COVID business restrictions in February of 2021. That was earlier than most states did. And, our retailers really benefit from that. There's states that were just getting full capacity in May, June, and still aren't there. So, overall, COVID definitely presented its challenges on the retail market, but Iowa, which is consistent with all of our segments, Iowa fared better than other larger markets. Moving on to big box retail. This is just the current inventory Q1 2021. 5.9% vacancy rate. You can see most of that's in the northeast and south corridor. Western suburbs has about 225,000 feet. That's taken up by about 4 to 5 large boxes. We did have some positive net absorption in Q1, which I'll talk about on the next slide here. Some notable backfills in the last year and a half. Lauren Decor filled the former Gordon's in West Des Moines. Just recently in Q1, Burlington Coat, they filled the former JCPenney home store in Clive. And then at Jordan Creek, Bob's Discount Furniture took the former Bed Bath & Beyond at West Des Moines. So, these backfills are just a testament that even in a COVID environment, these national retailers believe in Des Moines, they believe in our demographics, and they're wanting to be here. Switching to some of adaptive reuses. We're seeing these in corridors where the national retailers might not be looking, that northeast and south corridor. Landlords and developers are having to get creative with these big boxes. We've seen a lot of self-storage. Most recently, just last month, the former Aspen Fitness on Southeast 14th got bought by a group out of California. They're going to do some self-storage there. We expect to continue to see more of these adaptive reuses like that in these areas. And then something that surprised our entire market was the former Fresh Time on Mill Civic is going to be an office use for Iowa Realty. So, landlords just keep getting creative. We're going to continue to see them get creative with these boxes until we find uses for them. Ending with a bit of a future outlook on retail. What are the active corridors when national clients and tenants are coming to us and, looking, they continue to look in the Jordan Creek area, University Avenue and Ankeny. Those have always been kind of spots. We're also seeing the Hickman Road area on Waukee really start to blow up. Land prices in Waukee continue to impress. Almost everything's listed in that $20+ per square foot range for any quality outlot. So retailers are excited about that area. And then another area I want to touch on is the Grimes corridor. That's just been exploding. A lot of it is due to the $250 million mixed-use sports complex development developed by Hope Commercial. We've had tons of new entrants into that market. There's a brand new Hy-Vee that's getting ready to open. We've got a new Menards and Aldi, Arby's, Starbucks, Culver's, and a bunch of credit unions. There's plenty of land on 141 to continue to develop this retail, and we're really excited about that area. Future development, just a few more statistics. This last year, retail completions were down 29% year over year nationally. That's the lowest level in 10 years. That's due to multiple factors. We talked about the pandemic. We have rising land prices, and construction costs have also been going up. So that presents challenges. And if costs are going up, to have retail make sense, we need the rental rates to increase. And in 2020, those only rose by 0.9% nationally. It's the first time it's been under 1% since 2014. So it's made for a challenging environment, definitely for the speculative development. It is still happening in some areas. Stanborough is building the building out at Jordan Creek, Jordan West, and Hope Commercial is building a 22,000 square foot building that's 100% speculative out in Grimes. So really speaks to those corridors, and developers are still confident in those areas and leasing those buildings up. But in the future, we're expecting to see more pre-leasing and build-to-suit. Retailers might not, or developers might not be ready to start a building until they have some pre-leasing done. And that's just part of the changing retail environment. Overall, I'd say, retail has challenges before COVID, and COVID definitely accelerated those. It's an ever-changing environment, but there's still retail deals out there to be had. We're still getting calls on our strip centers, and we're just excited to keep doing business in the future. So with that said, I will give it to Cy Fox for a multifamily update.
Thanks, Grant, and thanks to everyone who tuned in online. Today I'll be discussing the multifamily outlook, as well as new construction deliveries and recent sales in the greater Des Moines metro. As you can see here, the average asking rent is $9.55 in our market today, slightly up year over year due to all the recent new construction deliveries we've had. Effective rent, though, is down slightly or flat in some cases due to rent concessions being offered throughout the pandemic and some still today. Going forward, the strong Des Moines economy, healthy levels of new supply, concession burn-off, and return of office workers should help propel an impressive recovery here in 2021 for the multifamily space. The market's currently experiencing 7% vacancy metro-wide, but young professionals and others looking for a change of pace continue to flock to Des Moines. This year, we're expected to deliver 1,637 new construction units, down 20% over the 5-year average, but up 50 or 500 units from what we delivered last year. Here's a chart showing previous 5-year average was 2,090 units, which is the green bar there. So we're down about 20% this year over the past 5-year average, which is good for the market to have an opportunity to catch its breath here. Talk about new construction pipeline here. So we scheduled to deliver 1,637 units this year. Most of those are taking place in eastern and western suburbs. According to our market survey of about 35,000 units, we show the lowest vacancy in the metro to be in the eastern suburbs at 4%. So probably a reason we're seeing a lot of new supply in that submarket. Provide a more detailed look here at the new construction pipeline. We've delivered 683 units year to date. 954 will come in the latter half of this year. Interesting point here is all of these projects are being developed by local developers, except for 3, 2 Sioux Falls-based companies and 1 based in Michigan, who already have a very significant existing portfolio in our market. U.S. multifamily volume dropped 27% in 2020 compared to the record-setting 2019. But locally, we had a record year in 2020 with both transaction volume and number of transactions. As you can see, 97 multifamily deals traded in 2020, which was just under $258 million, compared to $215 million and 66 transactions in 2019. A lot of the 2020 volume was based on a couple of major sales that I'll get into next. But first half of 2021, we're definitely on track to exceed number of deals. Maybe a little behind on deal volume, but I think that will certainly catch up. And especially with what's in the pipeline here, and I could see that exceeding 2020 level. Overall, though, we were impressed with how much we were able to trade last year with all the logistical issues with executing due diligence and market uncertainty. Here I'll talk about a few recent notable transactions in our market. Carbon 550 is a new construction 50-unit deal downtown Des Moines. It was the first deal in Des Moines to trade with existing remaining tax abatement. And that sold to a new-to-market buyer out of the East Coast, which you'll see a trend here. A lot of new-to-market capital in the list of transactions I have here. National Biscuit Company Flats, I'll touch on too. Carbon 550 actually has the watermark for highest price per unit. It set a record at $202,000 a unit. National Biscuit Company Flats, it's a very unique deal downtown, single resident occupancy restricted, 54 units, average square feet was 275 square feet, and sold for roughly $50 a unit. Those apartments actually don't have stoves in them, which is interesting. 10th Street Lofts is directly north of Biscuit, 94 units, sold with a 1-acre parking lot as well for $123 a unit. Rocket Transfer Lofts sold last December, 58 units downtown, 4 years of tax abatement remaining to a new-to-market buyer out of the West Coast, Southern California. Cadence sold earlier this year in Johnston, 195 units, new-to-market buyer from Chicago. White Oak in Johnston sold earlier this year, new-to-market buyer from North Dakota. Renew at Jordan Creek, 261 units, just north of West Glen, traded for $110 a unit. To the same buyer as Rocket Transfer Lofts. Hickman Flats, 203 units, closed a couple of weeks ago to a new-to-market buyer from Omaha. 1440 sold downtown at 14th and Locust, the Krause Group, right across from the Sculpture Park. That was a pre-COVID sale. BBK portfolio and Jerry's Homes portfolio were two very large transactions that took place at the end of 2020, which drove to a record-setting year as far as sales volume. BBK sold to an East Coast company new to the market. And then just last week, Willow Park and the Ridges, 2-property, 360-unit portfolio sold to a syndicator out of Dallas, and they intend to put roughly $10,000 per unit into that project for a value add. You've seen a lot of new capital entering our market, and here's some of the main reasons. You can find a yield premium in our market compared to other primary and secondary markets. We're underwriting more manageable rent growth at 3%, opposed to some of the larger cities that are upwards of 5 to 10% rent growth year over year. Obviously, you're experiencing strong population, employment, and job growth here, favorable market performance. Intense competition in the primary and secondary markets is chasing those buyers to focus on more tertiary markets like Des Moines. And then investment criteria from a lot of these groups is changing as they're looking at MSAs that may be smaller than 1 million population, for example. So Des Moines fits that criteria. And then overall forecast for 2021, expect multifamily to remain a favored investment target. The only concern is there may not be enough product for sale. Get calls daily from groups circling Des Moines. It's just about finding them product right now. And a lot of the recent top accolades that Des Moines has received as far as being on the front page of the Wall Street Journal and what the other Des Moines Partnership released about population growth is all caused great demand for our market here. Continue to be a seller's market with historically low cap rates as well, and a lot of new buyers entering the sector that have historically invested in office, retail, and hospitality. So with that, I'll turn it over to Tyler Dingle for a capital markets update. had about 30 minutes of material to go over with you guys today, but Bill told me to speed it up a little bit. We're running short on time, so I'm gonna hit the high level stuff and move on from there. But needless to say, the 2020 was a challenge for all markets that these guys have talked about, but we saw the same thing on the sales side. You know, most notably in that second quarter, you saw just a drastic decline in sales volume to a level that we haven't seen since Q1 of 2011. The third quarter really wasn't a lot better, but certainly moving in the right direction. You can see in the fourth quarter there, we actually had a pretty strong fourth quarter, and this is a trend that you'll see on the investment side is Q1 is typically the lightest, and growth continues throughout the year. And then as folks get towards the end of the year, figure out their tax play for that year, that there's typically more investment towards the end of the year. So we did see a strong fourth quarter. That was also really spurred by the interest rate market out there. Our interest rate levels hit an all-time low at the end of 2020. That they've come up slightly from there, probably around 50 basis points, but still overall a strong interest rate market. You can see there in Q1 2021, we took another dip back down. You know, the nice thing about these numbers is they're factual, they're accurate, but they also, it's a little bit backwards looking. It shows Q1, we're almost to the end of Q2 here, and I think my panelists here would agree that Q2 has been a strong market, or a strong quarter for us, and I think you're going to see that number increase significantly as we release our next set of numbers. I looked at the overall, I guess, which sectors took the overall largest hit. The numbers there on the right side of your screen is a year over year from Q1 21 compared to Q1 of 20. Some of those numbers are pretty staggering. As you can see, the hotel market took a 62% hit. Surprisingly to me, industrial at 46% hit. Not surprising, office and retail also took a hit there. As you look at Q1 versus Q1 of 2020, on the left side, those numbers, one number that really stuck out to me was the hotel piece at a 12.7% increase, which seems a little bit off, but that was really driven by one sale, a large portfolio sale of about $2.8 billion that really pushed that number up. But again, still working to come out of the COVID, if you want to call it recession, that kind of took place here, but I expect a lot stronger numbers than these going forward. Another big hit that we experienced was private companies and REITs really exited the market during the COVID. I don't know if that was a buying scenario or the fact that they didn't have folks in the office, maybe a combination of both, but about that market alone was down about 75% compared to previous years, which is a staggering number. Private investors really performed much better and stayed active in the market during that time period. And another important piece that investors look at is cap rate. That's what's going to determine the value of the property. And again, some surprising numbers to me on this piece. It kind of breaks down every segment and into some CBD, suburban, flex warehouse categories. And the CBD office cap rates actually compressed 18 basis points, which again, very, very interesting number there. I think with the amount of sales being down as much as they were, and my hunch is that the sales that did take place were very core assets in major markets, and folks that were taking more of a long-term play and taking advantage of the interest rates and buying some of those assets led to that decrease in cap rate. Not as surprising, industrial down 20 basis points, multifamily, as Cy was talking about, down 21 basis points across the board. So retail, hotel really kind of held steady, close with a small increase on cap rates. So looking more forward-looking as we go into Q2, Q3, and beyond, is where are investors looking to place that money? We did see an increase in opportunistic buying, distressed asset buying, and core asset buying, with a decrease in the value add and the core plus. So you start to get the feeling that investors are willing to take a little bit further step out on that risk spectrum a little bit, but still keeping that core asset in their portfolio. This kind of breaks down further that same type of a graph, but going back to 2017 and moving forward, you can see where that opportunistic and distressed asset class, and this is investor sentiment, investor forward-looking, what they're expecting to do in 2021. And then on the bottom left side of that figure 7, you can see where the investors are looking to place that money. Again, not surprising, industrial and logistics make up the largest piece of that at 36%. Multifamily not far behind at 29%, and then lagging behind them are the office market, hotel market, and retail markets. One asset class that I would point out that's not as well represented in these figures is that single-tenant net lease asset, particularly in the essential services category. And I know Grant talked about this a little bit on his retail slides, but that market really held up very well over the last year as folks were looking to invest their money into safer assets, assets with a longer-term lease and a strong company behind them. Those assets continue to perform well. A few things to kind of look at as we move into this year in the change of administration that's going to have a lot of effect on both our tax planning and some of our government regulations going forward. Capital gains tax is a huge focus for folks right now. As I'm talking with investors, they're looking at if capital gains increases to the ordinary tax level, that becomes a major deterrent for them to want to sell an asset. What doubles down on that concern is that if there's elimination of the 1031 exchange, the ability to exchange into a like-kind property, that exchange has been around for nearly 100 years. And for many years that I've been in the business, it's been talked about as, is that going to change? Is it going to be modified in any way? We've been able to fight that off, but it certainly is something that President Biden has looked at as a potential to fund he's got the American Families Plan, which is $1.8 trillion spending plan, and in order to fund that, that's one avenue that he's looking at. That would be a very big hit for real estate investment. So that's something that we certainly want to keep in place if at all possible. I talked a little bit about essential retailer demand already and the impact that they had in, let's see, so we have that market share, they were up 5.4% since 2019. Again, did not take near the hit in the investment market that most of the other industries had. And then talking with your accountant as you're looking at these deals, coming up with creative tax strategies, that's another way to try to work around whether that's a tax or capital gains tax increase or potential elimination of a 1031 is how do I shield myself from some of these taxes that may be increasing. I think you'll see this across a number of industries or segments, is looking at bonus depreciation and cost segregation. If you're looking at industrial, if you're looking at retail, multifamily, same way. If you're able to split out that investment from it might be concrete or it might be furnitures and fixtures or appliances in a multifamily property, a lot of folks are looking at a cost segregation where they can take that depreciation on those assets early on and help shield some of their tax liability. And there are a handful of assets out there that really yield to that better than others. So that's something that if you're in that scenario, certainly reach out to your CBRE professional and talk about how you can structure for that change. Bill, is that short and sweet enough for you there? Well, I also have the honor, I guess, to wrap this up for us. So on behalf of all of our colleagues here at CBRE Hubbell, we'd like to thank you for tuning in today. We'd like to thank you for your partnerships over the years. we couldn't do what we're able to do without you guys, so it's extremely important to us. So we do plan on being back in person, Market Survey 2022, with everyone's favorite, the open bar after the event. So for now, you're on your own tab. Thanks for tuning in.